Extending financial services to the underbanked, individuals with limited access to traditional banking services, is a crucial step towards economic inclusivity and a significant business opportunity. Millions worldwide remain outside the formal banking system, lacking access to savings accounts, credit, and insurance. Addressing this gap offers substantial opportunities for financial institutions to expand their customer base while playing a significant role in reducing economic inequality. Section 1. The scale and importance of the underbanked market economic inclusivity. One of the primary reasons the underbanked are such an essential focus for financial service providers is the market's sheer scale. Many underbanked individuals are in rapidly growing emerging markets. By creating financial products tailored to the needs and circumstances of these potential customers, businesses can tap into a significant growth opportunity. Moreover, as economic conditions improve globally, these once underbanked individuals could become more profitable customers. Technological innovations. Innovative technology is at the forefront of strategies to serve the underbanked. Mobile banking, for example, has proven to be a game changer. In regions like sub-Saharan Africa, mobile money services have provided financial services to millions who previously had no bank account. These services allow users to deposit, withdraw, and transfer money with a simple mobile device without needing a physical bank branch. Fintech innovations. Fintech innovations have introduced various financial products that are accessible and affordable for the underbanked. Peer-to-peer lending platforms, microfinance apps, and digital-only banks offer lower fees and more flexible account requirements than traditional banks. These services are designed with the needs of the underbanked in mind, providing features like low minimum balance requirements, simplified credit checks, and more understandable terms and conditions. Section 2. Challenges in serving the underbanked infrastructure limitations. Extending services to the underbanked is challenging. One major hurdle is the need for physical infrastructure, such as bank branches and ATMs, in many areas where the underbanked live. This is where mobile technology and agent banking come into play, allowing financial services to be delivered directly to customers, regardless of location. Agent bankers, often local shopkeepers or business owners, can provide essential banking services using point-of-sale devices and mobile gadgets. Financial literacy. Another challenge is the need for more financial literacy among the underbanked. Many individuals in this group need to familiarize themselves with basic economic concepts, making them cautious about using services that seem complicated or risky. To overcome this, financial service providers must invest in educational programs that help potential customers understand the benefits and risks of different financial products. Educated individuals are better equipped to make informed financial decisions, increasing their comfort level with these services. Building trust is also a significant factor in engaging the underbanked. Many individuals in this demographic have limited experience with formal financial institutions and may be skeptical of their motives. Regulatory challenges. Finally, regulatory challenges can impede efforts to serve the underbanked. Financial regulations are often designed with traditional banking models in mind and may not account for the unique models and technologies used to serve the underbanked. Navigating these regulations while innovating can be a delicate balance, requiring ongoing dialogue with regulatory bodies to guarantee adherence while surpassing the possible limits. Section 3. Impact on microfinance and small loans. Empowering low-income individuals. The impact of microfinance and small loans on global economic development has been profound, particularly in empowering low-income individuals and entrepreneurs in developing countries. These financial instruments have proven vital tools for promoting self-sufficiency, fostering small businesses, and alleviating poverty. By providing access to credit, often for the first time, microfinance institutions enable individuals to invest in their businesses, improve their living conditions, and create a ripple effect of economic activity in their communities. Support for entrepreneurs. Microfinance and small loans fill a critical gap left by traditional banking systems, which often deem low-income earners and small-scale entrepreneurs as unbankable due to their lack of collateral, irregular incomes, or poor credit histories. Microfinance institutions work differently by focusing on the potential for growth and sustainability rather than conventional creditworthiness. They provide smaller, manageable loans for individuals or small businesses, often accompanied by training and support to ensure borrowers have the skills necessary to succeed. Empowering women. These financial services are particularly empowering for women who have historically been underrepresented in economic activities, especially in developing countries. Women have used microloans to become entrepreneurs, support their families, and achieve financial independence. Studies have shown that women are more likely to reinvest their earnings in their communities and families, amplifying the social impact of microfinance. Challenges and technology integration. However, the sector has challenges. Interest rates for microloans can be high due to the administrative costs of managing numerous small loans and the increased risk involved in making personal loan arrangements without traditional collateral. These rates can sometimes burden borrowers, particularly if their businesses fail as expected. Additionally, there is the risk of over-indebtedness if individuals take on more debt than they can handle, which requires careful regulation and ethical lending practices. Section 4. Innovations that lower barriers to entry. Digital platforms and e-commerce innovations across various sectors have significantly transformed how new entrants access markets, reducing traditional barriers that once made starting businesses or entering specific industries daunting. These technological and strategic innovations have democratized access to resources, knowledge, and markets, enabling a wider variety of participants to enhance the global economy. One of the most significant innovations in recent years is the development of digital platforms that connect businesses with consumers directly, bypassing many of the traditional intermediaries. E-commerce platforms, for instance, allow small retailers to sell goods worldwide without requiring physical stores or extensive distribution networks. These platforms provide the necessary infrastructure to handle payments, logistics, and customer service, significantly lowering new retailers' entry barriers. Cloud computing has also revolutionized access to sophisticated computing resources. Previously, companies had to invest heavily in physical servers and IT infrastructure to run operations, a significant barrier for startups and small businesses. Today, cloud services offer scalable solutions where companies can pay for storage and computing power on demand, adjusting resources as their needs change. This flexibility allows startups to deploy advanced IT solutions without the initial heavy investment, leveling the playing field between established companies and new entrants. Fintech and crowdfunding. Another area where innovation is lowering barriers to entry is in financing. Traditionally, securing capital to start or grow a business involved rigorous processes and often required collateral that many new entrepreneurs needed help to provide. However, the emergence of fintech and crowdfunding platforms has transformed this landscape. Peer-to-peer lending and crowdfunding platforms enable entrepreneurs to raise money directly from investors and the public without going through traditional banking channels. This change has opened funding to a broader range of businesses, including those in niche or innovative sectors that typically struggle to secure bank financing, online learning, and skill development. Moreover, the proliferation of online learning resources and tools has dramatically lowered barriers to entry regarding education and skills development. Previously, acquiring advanced knowledge or training could be costly and time-consuming, requiring individuals to invest in formal education and training programs. Many learning platforms offer courses and tutorials on everything from essential business management to advanced artificial intelligence programming, often at low cost or even for free. This accessibility helps entrepreneurs and small businesses to quickly acquire the skills they need to compete and innovate effectively. 3D printing and digital marketing. 3D printing is revolutionizing manufacturing, empowering entrepreneurs and small businesses to create prototypes and products without costly molds or large production runs. This game-changing tech enables rapid prototyping and innovation with minimal investment. Meanwhile, digital marketing levels the playing field, giving small businesses the tools to connect with global audiences affordably. Platforms like Facebook and Instagram let companies target the right customers with cost-effective ads, boosting brand visibility and expanding clientele without breaking the bank. Together, these tools are reshaping how businesses create, market, and grow. Extending services to the underbanked demands innovation, partnerships, education, and trust. By overcoming these challenges, financial institutions can drive growth while fostering a more inclusive global economy. Microfinance, small loans, and collaborative efforts by nonprofits and governments highlight the power of technology and teamwork in breaking barriers and creating equitable economic opportunities worldwide.